Oh. Hmm. Okay, hi, good evening, everyone. Can everybody hear me or not?
Yes,
Well done, James. What about you gals? Laura, Holly, Tony,
Yes, I can hear you.
Laura,
Yes, I can hear you.
Tony?
Yes, I can hear you.
Good. Well, hi guys, my name is Warren and I'm a recently retired CPA. And I wrote this workshop because a lot of people, when you're going into business or even if you've been in business for a few years, it's very confusing as to the tax ramifications of all the different entities that you can choose from. So I'm hoping that what we do tonight will give you a clearer picture of what each entity can do for you from a tax point of view. Because as you know, every year comes around very quickly and we all have to file our pieces of paper and pay Uncle Sam his money. And particularly when you're in business, because a lot of business people do not pay as they go along like W-2 earners. But anyway, if you wouldn't mind putting on the PowerPoint presentation, I can take it from there. We have somebody just logging in now. I can't move it from here. The PowerPoint.
Are you ready to?
Yep. And blow it up full screen. Oh, is it? Yeah. Can everybody see that PowerPoint? Okay, the way I run my seminars, I encourage people to ask me questions on the way through. I don't go through the presentation, then ask the questions afterwards, although you're quite entitled to do that. But if something comes up when I'm explaining something and you're not quite sure of, please feel free to just chip in and say, hey, Warren, what do you mean by that? Or whatever the case may be. As I said, choosing a business entity, the tax consequences, reporting requirements and more. I don't know what the more is, but certainly you'll get tax consequences and reporting requirements. And as I said, I'm a retired CPA, so I have had over 20 years experience here in Colorado and about 25 years experience in Australia. But, and that's why my accent, everybody's saying, what's he saying? What's he saying? So today you're going to learn about types of business entities and what the tax implications are for each, steps you need to establish your business entity, the annual reporting requirements, and also the general requirements for reporting your income and expenses, because that's the important thing, and that's what you'll end up getting taxed on. So moving along.
Excuse me, Warren, I'm sorry to interrupt, but we're not able to see the slides, and I got a notice that there were other people were not able to see the slides.
Oh, well, let's see what we can do about that. I'm sorry, mate. It's probably share. No, I'm sorry, I'm clueless with this stuff.
¿Se regresa donde está el meeting?
Y luego ahí dice, ajá, pero regresas a donde está el meeting. ¿Dónde está en otro screen? ¿Dónde está? Ajá, y luego póngale share screen. Y luego póngale PowerPoint. Ajá. Y luego share.
Can everybody see it now?
Yes, we can see it.
Okay, good, good. We'll continue on. Let's see the slide. All right, okay. So there's a couple of caveats that I like to raise in this particular workshop. The entity choice can impact you in other important ways. So you've got to think about asset protection and your legal liability as to what that is to the general members of the public, your ability to raise capital, and there's also some operational aspects of it. And the operational aspects become more involved when you get down to the level of limited liability companies or corporations, whether they're C Corps or S Corps. Now, these are details, and I push this on to my legal brethren because I don't want to be told that I'm practicing law, but you really need, if you've got any issues about what to do with the entities as far as annual reports, annual meetings, directors' meetings, shareholders' meetings, and all that sort of stuff, you really should consult an attorney. I'm just doing today's seminar from a CPA's perspective, with obviously concerning with taxes, but I'm also going to get into the reporting requirements of various entities that you choose. Okay. I'm on 3. I want to go to 4. No, next one. That'll minimize it. You maybe the top right, next one over, that one, restore. Oh. Why isn't this working anymore? I know, well.
Just look at the PowerPoint.
Sorry, folks, we're having a little technical difficulties here. So just hang fire. Go and get a drink or something. This always goes, this presentation will go down better with whiskey, I'll tell you. That's certainly the one I was on, the one I wanted.
You wanted this one?
Yeah. Oh. Can everybody still see what's on the screen, hopefully? All right, I'll take silence as an answer. If you don't put up your hand, I will take it that you can see it. But,
We
okay.
can't see the slides.
Okay, it's back up, and if anybody can't see it, please scream out, but otherwise we'll proceed thinking you can see it. So I just wanted to go through a glossary of terms and acronyms that I use in this presentation. One is IRS. Now, everybody knows what the IRS is. It's the Department of Treasury Internal Revenue Service, i.e. the tax man. Internal Revenue Code, which is something like 2 volumes and several thousand of pages thick, comprehensive set of tax laws created by Congress, or should I say made a mess of by Congress. FICA. FICA is the Federal Insurance Contributions Act, which relates to employers having to match wages for employees. If any of you have been W-2 employees, you probably know that you have to pay into Social Security and Medicare, and the employer up to certain levels have to match whatever you put in. So basically you're putting in double, or you're getting double the amount that you have to put into Social Security and Medicare or FICA. SE tax, self-employment tax, is the same thing, and you will find in business that you will have to pay Social Security and Medicare, because by and large, with some small exceptions, when you are in business, you wear 2 hats. You wear the hat, you're an employer and you're an employee. So what does that mean? That means that as an employee, you have to pay into Social Security and Medicare. And as an employer, you have to match that and send both along to the government with your monthly payroll. So next slide, please, if I may. All right. Next one is the no, the one up. No, one down. That one. Yeah.
Excuse me, if you press the slideshow button at the very bottom next to the Zoom, then he can use the clicker and just click to the next slide on his own. It's the icon on the far right, close to the minus sign.
Got it. Thank you. Yeah, I can see it up there. Okay, so these are the selections that you may have when you want to or already are in business. The sole proprietorship is a partnership, the limited liability company, and a corporation. Now, the corporations can be broken down into C Corps or S Corps, and it just relates to the alphabetic letter relates to the particular section in the Internal Revenue Code which governs the taxation of these 2 entities. So they're the most common. Actually, you can get into things like trusts and so on, but that really is beyond the scope of this particular seminar. So, moving right along, sole proprietorship. Okay, you're in business, you just put your hat on and out you go by yourself, and you create a business of sorts, whatever that business may be. Selling things on the internet, selling things, a food truck, anything you can think of. What are the issues with sole proprietorships? Well, first of all, you get no legal protection. So when you're out there, let's say, for example, you set up a food truck okay, and you give somebody a pierogi, a hot dog, a hamburger, whatever, and they get sick. Well, they could come back and sue you for, botulism or something like that. And when they sue you, you are totally vulnerable to them. Let's say they win the lawsuit, then your personal assets, your house, your car, and whatever else you may have, your savings accounts, they're all at risk. So you've got to make sure when you venture into business as a sole proprietor, you at least have sufficient insurance coverage to make sure that you can be covered if somebody wants to sue you for any reason. Because when you interface with the public, then you're opening yourself to anybody who deals with you and is very unsatisfied for whatever reason with your job or your contract performance. Now, what do you do here tax-wise? You don't do anything as far as filing forms are concerned. All you do is you use your Social Security number to file your taxes, and you file IRS Form 1040, including what they call a Schedule C. And I'm pretty sure I've got one coming up in a minute. The Schedule C will allow you to put down all your business income and expenses on that Schedule C. And at the bottom of the Schedule C, it will produce a net income. That's what you get taxed on, net income. So self-employment tax, what is it and how does it work? Well, I briefly mentioned before that is Social Security and Medicare. You have to pay this if you are a sole proprietor and also if you're operating under other entities. But we're just talking about sole proprietorship at the moment. So what is it and how does it work? Well, I've already said it's FICA, it's Social Security and Medicare. Now, here's the rub. Let's make up a number that's easy for me to calculate. Let's say you make, you've taken in $400,000 worth of income and you've spent $300,000 getting that income, be it on product, be it on internet expenses, websites, whatever, and you've spent $300,000. So $400,000 worth of income, gross income, less $300,000 worth of expenses. That gives you a net income of $100,000. Now, if the $100,000 is your only income, in other words, you don't have interest, you don't have dividends, you don't have any other money coming in, that's what you'll pay your tax on. You'll pay on the $100,000 in whatever tax bracket that happens to land you in, probably around 10 or 15%. But self-employment tax also kicks in and you have to pay Medicare, Social Security, and double that because you, as I said before, you're the employer and you're the employee. So you've got to double up. So that particular, let me see, Social Security is 6.2% and Medicare is 1.45. So that gives you 7.65. Double it gives you 15.3. So on your $100,000 worth of net income, you've also got to pay $15,300 or close to it. There's some modification, which I'll mention in a minute. You've got to pay $15,300 in self-employment tax, Social Security and Medicare. And so you might grizzle about it because if you're young enough in business, you'll say, where the hell am I going to be when I'm 65 or 68? By the time you get up there, they'll probably have the retirement age at 85. But if you don't pay into the social security system, you won't get anything out of it. So that's really up to you, except if you're a sole proprietor, it's not up to you. The government will charge you that amount of money. Now, the caveat there is you get, because you're an employee because you're an employer as well, you get a deduction for the amount that you've contributed to the employee's Social Security. So you get a deduction of $7,650, which is your contribution it's the employer contribution to you, the employee. So that does temper the 15.3%, probably brings it down to, I'm guessing, maybe 12.5 or 13%. But that's something that you really need to be aware of, because I've had clients come in and say, how come I've only made $100,000 and I'm paying $40,000 in tax? I'm in the 40% bracket. That can't be right. Well, no, they're not, because Medicare and Social Security is not income tax. It's a separate impost. So whoever came in and said, I'm paying 40%, they weren't really. They're only paying 20% or 25%, and the balance was Social Security and Medicare. So you really need to be aware of that, because a lot of people go into business, and when they file their first tax return, it smacks them in the face like, what? So, okay, this is a CPA's idea of a joke, but I loaf on the job all the time, so I figure it's not really earned income. So the reason for that is Social Security and Medicare is imposed on what is referred to or regarded as earned income. And there is going to be a slight variation on earned income when we go a little bit further into these slides. There's a Schedule C that I mentioned before, and that just goes you'll see up the top left-hand corner, Schedule C, Form 1040. And you've got the legal business or whatever your business name, if you have a business name. You might be just operating on Fred Blogg's business, but you may have registered a business name. You can, it's called a DBA, doing business as, and you can register this, a name that you want to protect. You can register them with the Colorado Secretary of State. And the way you would do that, you would go onto the business section of the Colorado Secretary of State. And first of all, you'd have to search the name. So you've got to do a search on a business name to make sure nobody else has got it. And if nobody else has it, then you can pay, I think it's $10 or something, for registering that business name. And that name will be protected from anybody else using it in the state of Colorado. It won't protect you in the other 49 states. You would have to do that in every state. Or alternatively, if you've got something that's quite unique, then you may be able to copyright it or patent it on a national basis. But people tend to just have businesses confined to the state they operate in. So if it's just Colorado, you only need to register it with a Colorado Secretary of State. God, you're a quiet lot. No, you got any questions?
Warren, this is James. I have a question.
Yes, James.
What if we go, I understand we register with Secretary of State in Colorado.
Yeah.
What if we go national or international? Is it better to register a business in another state or set it up differently?
No, you don't have to. Well, it depends, James, what you want to do. If you go starting to do business in another state, then and let's say for argument's sake that you've got I know we haven't dealt with LLCs yet, but let's say you've got an LLC in Colorado. Then if you want to do business in Wyoming or New York or something, you really either have to set up a new entity or you'll have to register your Colorado entity as a foreign entity in those states. I know it sounds funny because foreign, well, I'm not registering overseas, but you would have to register that in each state that you're going to do business in.
And I'm sorry to interrupt, but what if we're strictly an online business?
Well, online business, you'll get some issues further down the line, but the name won't be an issue because you're operating an online business from the state of Colorado. You only really need to register it in Colorado. You don't need to go and register it all over the country.
Okay, thank you.
Unless it's something that is so peculiar to you that you want to protect it. So you don't want any knockoffs coming in from other states. But if you're just going on an online business and you set up the business in Colorado, you don't have to do anything else. Online businesses, they're becoming very much scrutinized of late from both a tax point of view and a sales tax point of view. But I'll talk about that a little later on. Partnerships, well, partnerships are not really used anymore. Sometimes you'll see large legal firms or accounting firms use LLPs, limited liability partnerships, and so on. But usually people, they will gravitate to an LLC rather than a partnership. Here's the go. If you are a general partner in a partnership, you are legally responsible for the debts of the partnership. So that makes you very, very vulnerable to any lawsuits or any actions taken by government agencies because you haven't complied in something. General partners have a great liability exposure and you wouldn't want to be one, frankly. There are some legal protections, like, as I mentioned, limited liability partnerships, where you're only risking the amount of your original investment and any personal guarantees that you might have given to secure funding for the partnership. I'm assuming a lot of people understand the term personal guarantee because in a business situation, if you go and try and borrow money and you haven't been in business for an established at least 3 to 5 years, then any loan that you negotiate with a bank is going to probably come with a personal guarantee from you, the owner, that if your business fails and the business doesn't repay the loan, you'll repay the loan. And banks are usually pretty damn good on getting a personal guarantee because they won't give you the loan unless they get it. So is that all right with you, James?
Yes, that's very helpful. I actually have a co-partner. So are you recommending we look at a LLP?
You have a what? You have a limited liability partnership.
That's correct. I have a partner.
Okay, all right, okay. Well, which one of you, usually if you don't designate, both of you will be the general partner, but with a limited partner situation, it'll only be the general partner, not the limited partner, that is vulnerable as far as the debts of the partnership are concerned. But if you wanted to dig more deeply into that, I really would suggest you talk to an attorney. you may have talked to an attorney, because there are not many businesses that I'm aware of. In fact, I don't think I've ever done one tax return for LLP. I've done a ton for all the others, but never for an LLP. So that in this day and age is a little bit of a peculiar animal. What, can I ask you why you went to an LLP?
Well, I went to an LLP because we had 50-50 partnership and we felt like that might be the best solution. But I'm about ready to launch another business, and I do have a partner as well. So I can structure this new one, but it's strictly online. It's in the health and wellness industry.
Yeah, now one thing I want to point out to you, and I don't want to dampen your enthusiasm, but when you're a 50-50, regardless of whether you're in a partnership, an LLC, or even a corporation or an S corporation, 50-50 means nobody has control. So if you want to do something and the other guy says, no, I ain't going to do it, you're at a stalemate because nobody can push the other line over. And I will address that a little later on when I talk about LLCs, but you could probably do it with LLPs as well.
Great, thank you.
You're welcome. So now it's not bloody working.
It's the other one. The other arrow.
You want me to try this? Okay, all right.
Yeah, the right one.
Yep. Now we turn to limited liability companies, the favorite child. Because why are they a favorite child? Because they're so easy to set up. They were originally created in Wyoming, of all places, in the 70s, 1970s, late 1970s. And they have effectively spread to everywhere in the United States. The United States and I believe South Africa are the only two countries in the world that have limited liability companies. I know from my years of being a CPA in Australia, they do not have one. They don't have limited liability companies in Australia. And I've also had clients that I've dealt with in England, in Switzerland, and a few other countries, and they don't have LLCs either. It's a peculiarly American creation. But it does have legal protection for its members. For example, unless, for example, it's a willful negligence claim. So if somebody can prove willful negligence in an LLC, then the members could be exposed to liability. But other than that, you do have limited liability, and that's why they call them limited liability companies. And
Yeah.
I got it. All right, I've got to get used to a new contraption here. Okay. So unlike a corporation, which has a different set of governing rules, LLCs have articles of organization. Articles of organization usually includes information about the scope of the business. It's got to be whatever business you embark on has to be a legal business. And it's multifaceted. So you could have one LLC with 5 different businesses. it could be an umbrella over 5 different businesses if you wanted to. I don't think that's a particularly good idea, but you can if you wanted to. You'll have contributions from members. Now, in a limited liability company, you don't have shareholders, you have members. And the members buy in and they are given an ownership percentage. So in James's reference there earlier, if you had 2 people going into an LLC, the membership would be 50% one, 50% the other, meaning or taking into the full 100% ownership of the limited liability company. The articles of organisation will also deal with what books of account you need to keep, and perhaps one member who's going to be responsible for keeping the books of account, and the control of the LLC, whether the control will be in the hands of managers or members. Now, with an LLC, you can create a manager and say, well, Fred here, he's going to be our managing member. And then Fred takes on that role and manages the LLC, deals with any issues that come up, and probably in most cases would also be the taxation representative and would be signing the LLC tax return. Now, what are you going to do with it? You've got to register an LLC with the Secretary of State. Now, that's why a lot of people go into LLCs. Nearly every LLC that I've ever dealt with from a client perspective have always been, they've never had any articles of organisation. All they do is go onto the Secretary of State site, register their LLC, and they've got the entity. Now, I don't know whether it's still going on or not. You'll have to check. But recently, to encourage businesses, the Secretary of State's office were reducing the fees of registering an LLC. Ordinarily, it would cost you $50 to register an LLC online. If you do it through the mail, it costs you $100. Go figure. But anyway, but they reduced the powers that be in Colorado reduced that to $1. So up till recently, and I don't know whether it's still there or not, frankly, it was only $1 to register an LLC. So it's pretty cheap chips for getting started in a business. So what do you do with an LLC? You can, if you want to, apply for an EIN. What's an EIN? It's the employer identification number. And the reason the IRS issue those is because they want to separate responsibilities. For example, you file your 1040, your annual tax return, be it joint or single, you file it under your Social Security number. They don't want you filing an LLC under your Social Security number. They want you to file it under a separate number, which is called an employer identification number. Now, the reason it's not necessary all the time is because the default classification for an LLC, it's the same for a partnership. Its default classification is a disregarded entity. Membership of one is classified as a disregarded entity for tax purposes. What does that mean? That means they don't want it, the IRS don't want to see a separate tax return. They don't want to see separate forms filed. All they want to see, and we go back to our Schedule C that we had before, which I illuminated on. And on the Schedule C, it will ask you whether you have an EIN, and if you do, the business has an EIN, you can put it, there's a space for it on the Schedule C. But you can also file a Schedule C because you're filing it in your own tax return. You're really filing it under your own Social Security number. Membership of 1. 9 times out of 10, husband and wife in an LLC is classified as one person. So that's the default entity classification, is a disregarded entity. So if husband and wife are in there, boom, it's a disregarded entity because they consider that a membership of 1. And if you ever go onto the IRS site and apply for an EIN, they step you through a series of questions. What are you filing for? Corporation, no, filing for an LLC. Is it one member or more than one member? Well, one member, boom, it's automatically a disregarded entity. If it's 2 members and the other member is not a spouse, then it will become a registered LLC and you will have to file a separate tax return for it. Now, same taxing requirements fall on members of an LLC as they do on sole proprietors and partners. The income is considered earned income. You remember earlier in the piece, I made reference to earned income. Members, typically, the IRS don't want members of an LLC to pay themselves a salary. Some people do and get away with it, but the IRS doesn't really want you to do that. So let's say you're in LLC and there's 2 of you, and one is the money man and the other is the sweat equity guy. And he's doing all the work. All you're doing is sitting back and having monthly meetings with him or something, but he's doing all the work. So ordinarily you'd want to pay him a salary for he's doing something over and above what his initial capital input was. So how do you do that? Well, then you can take guaranteed payments. Guaranteed payments are regular amounts. Let's say, for example, you've got Joe Dogsbody who is doing all the work in the LLC, and you decide to pay him $5,000 a month for the work that he's doing. So what happens? It's a guaranteed payment that he gets every month. He gets $5,000 every month, guaranteed. And there's no payroll involved in that at all. You just give him his $5,000 every month. Now, what happens with that tax-wise at the end of the year? Well, Joe Dogsbody has picked up $60,000 in guaranteed payments. The LLC has paid out $60,000 in guaranteed payments. The LLC will get a deduction for the guaranteed payments. So in our previous example of $400,000 worth of income and $300,000 worth of expenses, $100,000 and $60,000 worth of guaranteed payments. Now the LLC's income is $40,000. But Joe Dogsbody has got to pick up the $60,000 in his return as income. So it really washes itself out. And then at the end of the day, the $40,000 net income which is left after the $60,000 has been distributed is distributed to each member in their proportionate share. So in this case, 50-50, 40,000, 20,000 goes to Joe, 20,000 goes to Mr. Moneyman. That amount is included in your 1040 personal tax return. Distribution, sorry, I won't use that term. Net income from the LLC is, because the LLC is what they call a pass-through entity, the LLC in itself does not get taxed. So an LLC doesn't get taxed. Now, I heard the other day from a CPA friend of mine who said that the government is considering making paying the tax at the entity level instead of at the individual level. And there are some benefits in that to individual members of the LLC. But that apparently is only on the drawing board. So whether it comes to fruition or not, I have got no idea. But at the moment, what happens is LLC is filed as a 1065, which is a partnership return. It's filed as a 1065. So what happens here, I don't know whether I got a 1065. No, I don't. 1065 is the same tax returns you file for a partnership. And you put in all the details, your gross income, or you itemize all your expenses. Excuse me. And then that program will generate what is called a K1. And you'll see that's the last bullet point on that slide. Include a K1 transmittal document with Form 1065. So the Form 1065 goes into the IRS and with all the K1s. So in our example of Mr. Moneyman and Mr. Dogsbody, then what happens is he gets a K1 for $20,000. He gets a K1 for $21,000. And they include that amount in their personal tax return. Plus the K1 of Mr. Dogsbody will also show $60,000 worth of guaranteed payments. So he'll end up putting $80,000 in his tax return, and the other guy puts $20,000. And that's how it's taxed. It's taxed at an individual level, not at an entity level. So moving up the food chain, we've been through we've been through sole proprietor, we've been through partnership, and we've been through an LLC. The next cab off the rank is a corporation. Excuse me. Now, corporations are governed by articles of incorporation, not articles of organization. Corporations have a two-tier system of taxation. The corporation pays tax on its net income. Then the net income may or may not be, depending on the decision of the directors, the board of directors, as to whether they pay dividends out of those earned profits. If they pay dividends, then whoever gets the dividend, in what proportion they get their dividend, depends on how many shares they've got, they have to pay tax on that again in their own personal tax return. So corporations basically get hit twice with tax. So it's probably not a good idea to get a C corporation, unless, well, we'll talk about it a bit more. Tax year starting 2018, the corporate tax was brought down to 21%. Before then, it was 35%, but it was one of the most heavily taxed corporate rates in the world. And the 2017 Tax and Jobs Cuts Act, which was passed in December of 2017, took the corporate rate down to 21%. Congress are talking about putting it up again to maybe 25 or 26%. But it certainly brought a significant savings to corporations. I've got a note there about no special gains rate. You may or may not have heard there's a separate rate for capital gain. Capital gain is income of a different type. So when you're running a business, as I said in our example, you got $40,000 worth of net income. If you had, during the year, if you'd sold an asset in that business, let's say, for example, you had an SUV, a Dodge Ram truck, something like that for your business. And you'd bought it and you probably depreciated it over a couple of years. And the value, the depreciated value of it was $25,000. And somebody came along and said, boy, I like your truck. I'll give you $40,000 for it. Okay, so you sell the truck. Now, is that income? No, it's a capital gain. So what you do is you take the $25,000 that has been depreciated and you take that away from the $40,000 and you end up with a capital gain of $15,000. Now, if you're an individual, then that capital gain will be taxed at either 0, 10, or 20%, depending on what tax bracket you happen to be in. If you're excuse me, if you're single and you earn, say, $60,000, the chances that your capital gains tax will be 0. But in a company, it's not, you don't get a capital gain break, it's just income. So the $40,000, sorry, the $15,000 in my example just goes in as income and gets taxed at 21%. Is everybody following this, or is anybody lost at sea? Or? All right, nobody's saying anything, so I assume they're all right. A corporation does have total protection for all the shareholders. So you're only liable in a corporation for the amount that you paid for your shares. So if you paid $20,000 for your shares, then that's the extent of your liability. If the company goes belly up and it declares bankruptcy, you're only liable for the $20,000 and you'll lose it, obviously, but you won't be liable for anything else. You won't be liable for the debts of the corporation or anything like that. So that's why a lot of people will go for a corporation. There's an 1120 corporation tax return. Now, the point I was going to make, oh, I forgot what it was now. What I was going to make with corporations. Oh, 1120. It'll come back to me, don't worry. But now, as you probably all know, because you all file tax returns, 1040 tax returns, individuals, married filing jointly, head of household, whatever. They're all due typically on April the 15th. LLCs, partnerships, corporations, no, not corporations, S corporations are all due on March the 15th. Corporation, the C Corp is also due on April the 15th. They made some changes to that back in the Tax Cuts and Jobs Act. But these are required to be filed no later than April the 15th, or if you extend them, they'll be extended to October the 15th. You get a 6-month extension, just the same as you would for a personal tax return. So now the other corporation is an S corporation. An S corporation is a pass-through entity, the same as a partnership or an LLC. In other words, the tax burden is picked up by the members, the shareholders, not the S corporation. It passes through. The income and the expenses go through the S corporation, and then the net income at the bottom goes out to the shareholders of the S corporation, and they pay tax on that at their level. So it's the same as partnership and LLCs. It can be limited in numbers and residency. There are certain rules about non-resident aliens. So if I've got somebody who lives in England and wants to be a member of an S corporation, there's a whole rigmarole they've got to go through by getting into a business trust. It's a fairly complicated business. By and large, they can't be shareholders in an S corporation. They've got to be US residents or citizens. You file under you file under subchapter S of the Internal Revenue Code. You have to specifically file, I think it's a 2258 form, which asks the IRS to grant you S corporation status. You can't just go in and say, I'm an S corp. You've got to ask the IRS permission. Typically, they don't knock you back. They always grant you, unless you're late in asking for it. And you've got to file it 2.5 months after the corporation of the company, or the beginning of the applicable year that you want to exercise the S corporation. So let's say, let me give you an example so it's easy to understand. You set up a corporation in December of 2022, then you have until March the 15th, 2023 to file a request for the IRS to grant you S corporation status.
Warren, can you say the form number again you're supposed to file?
For a what?
For an S corp. So we did our EIN and selected it as an S corp back in May, but I don't think we filed any additional forms. So I guess my question is, what form are we supposed to file? And then what happens if we exceeded that 2.5 months?
Well, the problem is that did you get a corporation, or did you change an LLC classification?
We registered under an S corporation
You registered what?
with the IRS for our EIN.
Okay. Well, what you're supposed to do is have a corporation. Now, when did you get the corporation?
On June 2nd.
June 2nd. So you would have had 2.5 months after June 2nd to apply for and be granted S corporation status. Now, if you didn't do that and you send it in now, you can beg forgiveness and maybe they'll grant it to you retroactively. But the chances are they won't give you S status until 2023.
Okay. And then if they don't give us S status till 2023, would it just be an LLC for this tax year?
No, it'd probably be a corporation for this tax year.
Okay.
Because, you know, you can change the classification of an LLC, but if you start out as a corporation and you want to be an S corporation, then you've got a corporation. And if you're not granted the S status, then you're a C corporation. There's only two classifications. And a C corporation means that you've got to pay tax at the corporate level, not at the individual shareholder level. Does that make sense?
Yes. Yeah, I got it. So
I
I
mean-
should still file the form, the 2553 form, I think it was. I should still file it in hopes to get the S Corp status for at least the 2023.
Yeah, right. Now, what I would do when I was filing it would be to send in a letter with it to say, you know, we're sorry, we're newbies at this. We didn't really know that you had to pull the trigger, and they may grant it to you retroactively. So they may grant it to you going back to June of 2022 onwards. So that
Okay.
means that anything you file for 2022 will be S corporation. Okay.
Okay.
And as I've indicated down the bottom, you can change the filing status of an LLC or a C corporation to an S corporation. Now, C corporations are a little more difficult to change to an S corporation if you've been in business for a number of years, because there may be some undistributed earnings and profits that you'd have to get rid of before you became an S corp, because an S corp is a pass-through entity and a C corp is taxed at the entity level, not at the individual shareholder level. So there could be some issues there going from a C corp to an S corp, but there are no issues going from an LLC to an S corp because they're both pass-through entities. Now, here's the big difference. Here's the big difference. And this is why a lot of people they're not as popular as they used to be, but people still like S corporations because income from an S corporation is not considered earned income. So if it's not considered earned income, what don't you have to pay? You don't have to pay Social Security and Medicare. So you'll see in my examples later on in the slides that there is a difference from a tax point of view because you are not paying Social Security and Medicare. By the same token, if you're in an S corporation for 45 years or something, and there will be no Social Security for you to collect. You'll still get Medicare, I think, but you won't get Social Security because you haven't paid into it. And an S corporation files a form 1120S, which is right there. 1120S, Department of Revenue, Department of Treasury, Internal Revenue Service. Now, here's another thing with S corporations. Because you don't get Social Security and Medicare on your earnings from S corporations, the IRS expect you to pay the shareholders who are working in the business, they expect you to pay a salary to yourself. So let's go back to our LLC example. And I said, they don't want you to pay a salary. and Joe Dog's Body ended up getting $60,000 of guaranteed payments. So now you're in an S corporation and you've got the same setup there, Mr. Moneyman and Joe Dog's Body, who does all the work, and you want to pay him the same amount of money, $5,000 a month. Okay, then you pay him a salary and you deduct, obviously, if you pay him a salary, you have to pay Social Security and Medicare. Now, one of the audit triggers for, oh, I can't. Further down in this form, there'll be a specific section which says compensation of officers. So if you've got an S Corp and let's say you're making 100 grand a year in net income, but you don't pay anybody a salary, that could be snagged for audit purposes. Because I'll give you a case study. A number of years ago, a dentist had an S Corp and he was making $400,000 a year, passing through the S Corp and not paying any Social Security and Medicare on it, just pay whatever his regular tax was. The IRS investigated him and hit him with about $200,000 worth of salary. They said, no, this is not going to fly. You have to pay yourself a salary. And under the circumstances, they determined that I think it was 150 or 200 grand or something like that was reasonable compensation. So he ended up, they reclassified half the earnings into salary and they hit him with payroll taxes, withholdings, Social Security and Medicare, plus a ton of penalties as well. So he took them to a tax court, but he lost. So be a little wary. Now people will call me and say, hey, Warren, what will I pay myself? How much will I pay myself? Well, the answer is usually, what would you pay somebody to do your job? And that's usually the amount you would settle on. Now, for those clients, and I had a number of them that just had S corporations for their business. And one client comes to mind, had a computer consulting business, but he only had one client. And he got all his business from the one client. But he only did $40,000 a year in gross income. Didn't have much in the way of deduction. 40 grand in gross income. I said, don't worry, don't pay yourself a salary. And there was another reason for that. He happened to be a foreign national who was resident in the US, but didn't want to pay into the Social Security system because he'd never get it. He'd move back to the country of origin. He'd just never get his Social Security, because to qualify for Social Security, you have to be employed for 40 quarters, 10 years. Doesn't have to be continuous. It can be 3 years here, miss a couple of years, 5 years here or something. But if you don't have 10 years up, you won't get any Social Security. And a lot of foreign nationals that move to the US because they've got business opportunities here, or one of the spouses gets transferred here and the other spouse comes along and decides to start a business, they usually go into S Corp so they don't pay into the American Social Security system because they know they're never going to get any money back. But so that's the deal with S Corps. And that's why the issue with the Social Security and Medicare is a big deal with a lot of people that have S Corps.
Excuse me, I have a question. Is if the owner is receiving a salary, does he need or does she needs to be in the under W-2, or could she, or he can just get a salary, a flat salary without deduction of FICA taxes?
No, you've always got to pay, if you get a salary, that is quote earned income.
So earned income, okay.
So you've always got to pay withholding, federal withholding, state withholding, Social Security and Medicare.
So he has to be in the payroll,
He has to be, yeah, you have to do a payroll.
okay.
If one of the people or two of the people or whatever in an S corp has to be paid a salary, then you've got to get payroll going. Now, just as an observation, if you ever happen to have employees,
Mhm.
do not, underline, do not try and do payroll by yourself. It's a nightmare. It is a nightmare. And always, I mean, a lot of the computer companies like, what is it? Intuit, TurboTax, a lot of them have payroll systems as well. And maybe it's good to take advantage of that, because if you go into a PEO organization, which is a personal employment organization, it usually costs you a fair bit of money to what you've effectively done is outsource your payroll and typically your human resources. But that comes with a fee. So unless you're making good money, then most people can't afford that. But trying to figure, there's two things you should never try and figure. One is payroll tax and the other is Colorado sales tax, which I'll briefly discuss, getting back to my friend up here in the corner, James. There's some big issue, James, with sales tax and income tax with cross-state line internet commerce. And I'll talk to you about that in a little bit.
Warren, just a question. Is it, would you recommend using TurboTax as an accounting software?
No, I wouldn't. I'd recommend you go to a CPA and get them to do it. TurboTax is sort of tax for dummies, I guess. I mean, it does take you through a series.
There's quite a few people using it. I just.
Well, yeah, but it takes you through a series of, do you have a W-2? Yes. Do you have a business? Yes. But there are some nuances that it doesn't take you through and doesn't pick up. So, for example, if you're talking about a partnership return, it's going to be a lot more expensive. The corporate stuff or partnership programs for TurboTax, which is basically Intuit that own that, they are a lot more expensive than the $30 you pay at Home Depot, what do you call it, Office Depot or any of those Staples. They're a lot more expensive. They're up in the couple of $100 area. So one of the things I was going to recommend, but you've jumped the gun, is to get yourself a good, and I say CPA, okay, it might cost you a bit more than going to H&R Block or Jackson Hewitt or something like that. But CPAs have to pass, first of all, they've got to have a university degree, and these days they've got to have a master's degree, and they've got to pass a fairly rigorous set of exams. Trust me, I know, because I had to sit for them.
And Warren, quick question. How would you screen a CPA once you're talking to them? What are we looking for?
Well, what I advise people to do is to, first of all, you could go on to the Colorado Society of CPAs and search their database. You can also go on to the Department of Regulatory Agencies, the accountancy department, the accountancy agency, and search for CPAs. What I recommend people do is search for CPAs in the area that they want to go to. Like you live in Englewood, we'll search Englewood for CPAs, or you live in Highlands Ranch, do the same thing there. Pick out 2 or 3 and go along and interview them and say, this is my business. Have you had, do you have clients that have this type of business? And get to know them, because to me, they're like a doctor to me. You've got to be comfortable with them. And if you're not comfortable with a doctor, you shouldn't be going there. And if you're not comfortable with the CPA, then you shouldn't be going to him. But they do have an extensive knowledge, and they also have to do 80 hours of continuing education every 2 years. So that ensures that they keep up with the latest and the greatest. So that's how I would handle it, James. Does that help?
Yep, that's great. Thank you.
You're welcome.
James, we have one that we've been using, and I think she's amazing. I can include her email in the chat if you would like to reach out to her.
Oh, thank you. I appreciate that.
Of course.
Okay, well, that's something good. A referral's come out of that, which I can't give you, but anyway, somebody else can. This is a brief summary of the Tax Cuts and Jobs Act of 2017. There is not a lot, and I was questioning people the other night, there's not a lot in the Inflation Act that just came through from a tax point of view. It did extend and expand a couple of tax credits for installing solar and energy efficient not machines, but, you know, boilers and windows and stuff like that. And that was always subject to renewal each year, but the Inflation Act extended it till the end of 2023. But they also, as you probably read, they totally cut out the electric vehicle credit. Or they didn't cut it out, you still can get it, but there are certain conditions now that it's got to be 90% assembled in the US. It's got to be assembled of parts that come from US friendly trading partners. And guess who that rules out? If you said China, you'd be right. So it rules out China, which makes about 95% of everything in the world. But so they've made it a lot difficult. But it's having a desired effect, because a lot of the motor vehicle manufacturers are now opening and establishing plants here, you know, manufacturing plants in the US, so they can offer people the credit. And the credit was quite extensive. It's $7,500 from a federal point of view and $4,500 from state point of view. So there's $12,000 that a lot of people didn't get if they bought a car. I think it was after August the 17th. But other than that, there's not a lot of tax issues in the Inflation Act. It's mainly, I think, allocating money for infrastructure, be it roads, bridges, even internet stuff. But so the last major tax act was the Tax Cuts and Jobs Act of 2017. And they changed capital gains. This is a bit, I understand this is probably trivia and you walk away saying, oh, I don't care if I forget that. and you won't bring it up in any cocktail conversation, but capital gains, you used to be able to defer capital gain by, defer capital gain. So as long as you bought something to replace it, and it was called a like-kind exchange. So for example, if you had a truck, going back to our example, where you had the $25,000 truck and you sold it for $40,000, if you went and bought another truck, a like asset, you could defer the $15,000 and incorporate it in the next truck. And what you're doing is, like Congress does all the time, you're kicking the can down the road. And all you're doing is really putting off the day when you pay capital gains. They wiped that out and said, no, we'll only allow real estate now. Real property is the only way you can defer capital gain. So with the guys with the trucks and all the rest of it, can't do it anymore. You can only do it if you, say, have a shopping center or a house or something like that, and you sell it and it was the investment property and you've made, I'll give you an example. I had a client that sold a shopping center for 15 million and bought another one for 20 million. Well, we did an exchange, a like-kind exchange on that. And there's rigmarole you've got to go through. You've got to make sure that you get a qualified intermediary. You can't, nobody in the organization can handle the money and yada, yada, yada. And they just pile on the capital gain. So when they sell, assuming they sell the $20 million property, then they'll be paying capital gains on what they should have when they sell the other property. But I'm sure $15 million properties are not in your purview at the moment, so I'll go on and not worry about it. Counting method exchange, oh yeah, 25 million. There are three methods of accounting, and you may have heard of them. One's called accrual accounting, the other one is cash accounting, and the other one is a combination thereof. And the IRS, basically the third one's a hybrid. Now the IRS will accept any of those up to annual revenues of 25 million, over which you have to use the accrual method. But cash method is basically money in, money out. Doesn't matter when it's for. Money in this year, money out this year, boom, end of story, net income is so and so. Accrual is more, well, I got this invoice for September, so I really need to put it in September's expenses. The invoice for September may not get paid until October or even November, but it's been put into the relevant period in which it was incurred. And it gets a little more complicated than that. Most businesses, small businesses, pretty much run on a cash basis. And you guys will probably do the same thing. It's just easier to keep track of. You don't have to have accounts payable and accounts receivable. You just send the bill out, and when you get it paid, that's whatever month it gets paid, it's the month it gets paid. End of story. Cost recovery method, I won't deal with those at the moment. I'll go to the next slide first. Let's talk about what do they define? What does the Internal Revenue Code, Section 61, define gross income? It doesn't define gross income. It just says it includes, but is not limited to, compensation for services, commissions, fees, similar items, or cash or in kind. So if you barter something, you say to your local I don't know, your local hot tub man or pool man, if you service my hot tub, and you're a dentist, say, I'll do your teeth for free or something like that. That's a barter, and everybody's heard of a barter system. You're actually supposed to, you can imagine how many people do, but you're supposed to put a value on that and include it in your tax returns. And as I said, you can imagine the number of people that do that. But moving right along, gross proceeds are the conduct of any business enterprise, whether it's legal or illegal. And I say illegal, there was a very, very famous, it went all the way up to the Supreme Court, where the IRS snagged a drug dealer and said that he evaded tax on, I think it was $10 million or something. And they slugged him tax and penalties and God knows what. And he took them to court. And because it was illegal under the relevant section, I can't remember what it is now, 260 or something, you cannot deduct any expenses against illegally gained income. And he took them to court and he said, I must at least be able to deduct my cost of goods, which were $5 million or something. And that went all the way up to the Supreme Court, and the Supreme Court said, yes, he's entitled to deduct it. So he cut his tax bill in half by deducting that. But typically, it's the same thing with marijuana businesses. Marijuana, as you all know, is legal in Colorado, but is still illegal from a federal point of view. So the only deductions you can get from a marijuana business is your cost of goods sold. Your telephone, your car, your advertising, your anything else you can think of, nothing. It's got to be cost of goods or you get nothing. So frankly, they are pretty highly taxed, marijuana businesses. And they also had an issue with payroll, because payroll taxes have to be paid into the FPOS system of the Internal Revenue. And the marijuana purveyors couldn't open a bank account. No bank would allow them to have a bank account. So they couldn't pay electronically. All they could do was pay in cash. And that was a real sticking point for years. I think Michael Bennett was the one that pushed through a bill which allowed banks to have marijuana growers and purveyors as customers. But it was a bit of a joust there for a while. So gross proceeds, whether it's legal or illegal, interest, dividends, royalties, similar items to that. Partners, stockhold share of business entity proceeds. These are the K1s that I talked about earlier. Your K1s will show what you earn from the business and whether the earnings are earned income or not. For example, if you are a limited member in an LLC and you're not a general member, then your income for a limited member is not subject to self-employment tax. Social Security and Medicare is not subject to that. So you only pay tax on what you get. You don't pay Social Security and Medicare on it if you are a limited partner. In other words, you don't have much say in the business or anything like that. Other items, pensions, trust, estate income, that's a whole different ball of wax, you know. Ordinary income versus passive income and capital gains, short and term. There's two types of capital gains. One short term, within 12 months. Long term is 12 months and a day. If you've owned something for 12 months and a day and you sell it, it's a long-term capital gain. You get preferential tax rates. If you buy and sell within a year, you don't get the preferential tax rates. But if you make any short-term losses, you can offset them against any long-term gains. But this is getting a little bit stuff that you probably won't run into for a while. Now, what can you deduct? Well, you can deduct any expense that's directly in relation to the operation of your business that is not specifically prohibited or modified by law. So, for example, we'll go through these in a minute. What you could claim generally would be advertising, bank charges, accounting fees, computer fees, internet connections, telephones, rent if you're renting a business. If you're renting an office or a warehouse or anything like that. They're all deductible directly off your gross income. Things aren't deductible, such as capital costs. You go out and buy a motor vehicle, well, you can't deduct that ordinarily as a regular ordinary expense. There are special provisions which allow you to take bonus depreciation and you can write off in 1 year. But those provisions ebb and flow depending on who's in charge of Congress and who wants to move against them or support them. Meals and entertainment. Meals are generally limited to 50%. So if you take a client out for dinner at Shanahan's or something like that, you can claim 50% of that as deductible. But if you go to Shanahan's and then you take him to a concert afterwards, the concert's not deductible. Penalties and fines. You can never get a deduction for penalties and fines because otherwise it would ruin the effect of it. So if you ever get a parking ticket or anything, you can't deduct those. Items that are considered personal in nature. Clothing, for example. A lot of TV anchors and stuff think that they should be able to write off their Armani suits and all the rest of it because they've got to present themselves to the public. Not deductible. End of story. If you have a shirt or a pair of overalls that have got, Fred's sewer service on it or something like that, then the purchase of that and the cleaning of that is deductible because it can be, you can't wear it anywhere else. You wouldn't wear Ted's sewer service to a concert or to a restaurant or something. I don't think, but maybe some people would. But anyway, commuting expenses to and from work. If you're a W-2 employee, can't get it. Not on. End of story. You can get it, and I'll tell you about that just a little later on. What have I got? Special allowances. Examples. These are all examples. Now, I don't know whether you guys can get, well, I tell you what, if you want this PowerPoint presentation, I'm happy to send it to you and I'll give you my email address. And if you want to raise your hand and say, Warren, can you send me a presentation? I'm happy to email it to you. So auto expenses, bank credit card charges, cost of goods sold, if you're an inventory-based business, computer services and software, including off-the-shelf software. So your TurboTax that James brought up, that's deductible, even TurboTax for companies and partnerships. But if you go and employ somebody to write a specific program for you, that is not. Sorry, I just dropped something. Oh. Get myself sorted out there in a minute. That is not deductible. You'd have to amortize that over usually the life of the asset or 15 years. Dues and subscriptions, filing fees every year. If you've got an LLC or you've got a corporation or something, you've got filing fees, you've got to pay their deductible insurances, in-net services, interest on loans. A lot of people think they can deduct a loan, the amount they pay on a loan. You can't. You only get the interest you're paying, not the principal. So that's an important distinction because a lot of people think, oh, you know, it's not like a lease. A loan is a loan. It's got two components. It's got principal and interest, and you only get the interest deductible. Meals and travel, I've mentioned those. Office supplies, postages, delivery, publications, rent, telephone. That's not a be all and end all, but it's a sort of a laundry list. And
Warren, if you use your house for office space, are you able to write off any portion of your mortgage? I know you could do your rent, but if it's associated with a mortgage?
yes, you can, and I'll tell you how to do that in a minute.
Okay.
Corporate tax rate 35.21, we talked about that. Entertainment and meal, we talked about that. Net operating losses, you don't really need to know about those. Now, here's an important change that they made in that Tax Cuts and Jobs Act. Section 199A, deduction for certain business owners, 20% of your qualified business income, subject to limitations, which are shown down the bottom, is a deduction you're allowed on your personal tax return. So let's go back to our dog's body and Mr. Moneyman who made $40,000, $20,000 a piece. That is genuine business income. So they would get 20% of $2,000, which is $4,000 on deductible on their personal returns. So that was an added bonus. You can do that if you're a sole proprietor, a partner, an LLC member if it's earned income, and that's it. You don't get it for S corporations or C corporations. You only get it for those three prior ones. But it's a big, I mean, you know, if you make 50 grand, I mean, 20%, there's $10,000 extra that you can deduct off your tax return. That could make a big difference. And here is just specified service businesses, depending on your income level, you know, for accountants, for architects and stuff like that, you can't deduct it if you can't get it, I mean. If your income is in excess of these amounts, one's single, the other one's married, filing jointly. Now, this is an example of tax. So, tax payable. So you've got $140,000 here of gross receipts. You've got $40,000 worth of expenses. You've got $100,000 worth of net income. As a sole proprietor, assuming the 20% rate for an owner and the deduction of the qualified business income, you're paying $16,000 in tax. That's income tax. Then you're paying $76.50 as the employee and another $76.50 as the employer. So that ends up, I don't know where, I doesn't look, can I get rid of that? Dr. Top. There, good. Okay, so that gives you a total tax bill or a impost of 31,300. You get the same with a partnership unless you're a limited partner, and you get the same with an LLC unless you're a limited member. And then if you're a limited member, you don't have to pay self-employment tax. So you get rid of that if you're a limited member. If you're not a limited member, you've got to pay that. Now, an S corporation is a pass-through entity. You pay the tax at the individual level of $16,000, end of story. There is no self-employment tax, there's no Social Security and Medicare. Corporation, your tax rate's 21%, so it's $21,000. And assuming you make the difference of what's that, 79,000, and you distribute it as dividends, then it's taxed at the shareholder marginal rate. So it will vary from shareholder to shareholder depending on how much income they've got. So that's something that you can, but you can see that the Social Security and Medicare makes a big difference in how much money you got to part with at the end of the year. Now, I'm going to get back to the young lady's question about the house. For a number of years, the IRS were quite dirty on people deducting expenses of a home office. Typically, if you could substantiate it, you would be able to get, depending on the amount of space that the office took out of your house, let's say it was 10%, you could deduct 10% of the heating bills, 10% of your mortgage interest, 10% of, I don't know what else, property taxes, 10% of, what else do you pay? HOA dues, et cetera, et cetera. You could do all of that. The IRS were really dirty about that, and they would usually knock it out or investigate or audit you or something. Then, I think from pressure from everybody in Congress, they went out and said, okay, here's what we're going to do. We're going to give you an allowance of $5 a square foot for the number of square feet that you use. So if you've got 100 square feet of office space, you'll get $5 a square foot. If you've got, and it's a maximum of 300 square feet. Excuse me. So it's a maximum of $1,500. But you don't have to prove anything. You don't have to go through the machinations of 10% of this or 15% of this or something like that. I never recommended that to clients because if you start depreciating the house, your personal residence is tax-free up to $250,000 or $500,000, depending on whether you're single or married. That's the amount of gain, not the cost, it's the amount of gain. So if you bought a house for $250,000 and sell it for $500,000, then the gain $250,000 is tax-free. If you start depreciating the house because you've got a tax deduction for it, you've got all sorts of write-back issues and stuff like that. I don't recommend that because you'll really send yourself crazy. So the only parameters you've got to take into account is it can't be for anything else. It can't be the dining room table where everybody eats and stuff and you put your computer out after all the kids go to bed. It's got to be a designated spot, like a bedroom where you clear everything out, put a desk, a chair, a computer, a fax line, nobody uses faxes anymore, a phone line, whatever. But it's got to be a dedicated space. But I would recommend that you just multiply the space you have with your $5 a square foot. Does that answer your question? The lady that asked me the question.
Yes, it does. Thank you.
You're welcome. You're welcome. So that's probably pretty much the end of my speaks. So I'll just go through this with you. To your, James, I'll just, I got 10 minutes left. The issue that you've got with cross-border internet stuff, first of all, income tax. A lot of states now are targeting sales in their state. So, for example, Arkansas, if you sell something to somebody in Arkansas, they regard that as an Arkansas sale. And given certain parameters, if you get big enough, you might have to start filing income taxes in Arkansas. And typically, you should be able to deduct those in Colorado, what you're paying to another state, and only pay tax on the Colorado portion. But some states don't necessarily allow you to deduct it. So it's quite possible under the current circumstances. It's called market-based sourcing. And under the circumstances, you could end up paying tax on the same amount of money 3 or 4 times. Now, the other issue, but the saving grace there, James, is most states have a bright line. So you've got to sell more than, for example, California, $500,000. So if you sell under 500,000, you don't have to pay anything. Some other states might have 100 or 250,000 and a bright line to say, okay, anything below that, don't worry about it. Anything above that, yes, you've got to start paying. The other issue you've got is sales tax. Now, Colorado doesn't typically charge sales tax on labor derived income, mainly only product income. There are certain products that are exempt, like building materials and stuff like that. The problem with Colorado, for a start, is that you've got something like 150 counties and 51 or 52 home rule cities. Home rule cities means they set and collect their own sales tax. So the problem with Colorado, if you're sitting here and you're selling something to somebody in Pueblo, Pueblo is a home rule city, so they want to charge tax. And so you've got to make sure that you pay Pueblo. And with a lot of the other counties, if you just pay your sales tax into the Department of Revenue, they will take care of the distribution. But some of these home rule cities, they won't allow that. So Colorado sales tax is a nightmare. It is a damned nightmare. It's Byzantine and it's all the above. But if you're not selling product, then typically, you know, if you're selling services, you will still maybe get income tax, but you probably wouldn't get, in most cases, sales tax. So without giving me are you selling product or services?
Products,
Sorry?
products.
What do you say?
Products.
Products. Yeah, well, you want to take a look at the Wayfair case that was decided at the Supreme Court in 2018, I think. And the Wayfair group is located in, I'm not sure where they're located, but anyway, they're in South Dakota. And they're only selling in South Dakota. They had no physical presence. And before this was decided in 2018, the test was to tax somebody was whether you had nexus in the state. In other words, some attachment to the state. So the attachment could be a building, could be employees that you have in that state, a number of things that physically attach you to the state. And then the states start to say, well, hang on, we don't believe in that crap anymore. No, we're going to tax you if you're selling in our state. Anyway, bottom line, South Dakota Department of Revenue taxed Wayfair, and Wayfair, of course, is a huge company, I know, but they taxed them on their sales in South Dakota. And Wayfair took them all the way to the Supreme Court and they lost. South Dakota won. And so therefore, since that case, more states are doing it. And that was sales tax. Now, I don't know off the top of my head whether there's a bright line for sales tax. There probably is in most states, but you should, here's what you would do. You were talking about engaging a CPA. That's one of the questions you should ask them. Do you have anybody, any client that's paying sales tax or income tax in other states, but are operating from Colorado? That would be a good start to find out whether they know, because trust me, I did this for a client and it's a damn nightmare. It really is a nightmare to find out which states are market-based source states and which states have low thresholds for sales tax and stuff like that. So there you go. There's a tip. Make sure that they know what they're talking about.
Thank you.
You're welcome. So anybody else? Oh, yeah, be wary of internet invitation. If you go online and say, I want to apply for an EIN, you won't get the IRS website coming up first. You'll get something like LegalZoom or, you know, EINs for you or something like that. And a lot of people accidentally click on it and go through the question and answer session. And then at the end of it, they say, well, send us your email address and $150 and we'll organize it for you. Well, you know, as I said to you before, regardless of the dollar come on that the Secretary of State, it's only going to cost you $50. And you can bet if you get involved with LegalZoom or any of these other ones, they will be sending you notices each year because you have to file an annual return for an LLC, and that costs you $10 to file. And the LegalZoom people, I've had clients get them. Oh, look, we'll file your annual returns coming up. We'll file it $150. And it's just, you know, it's money for jam, really. But so be careful of that. So if you want to get an EIN, make sure you click on the IRS website. It's a fairly simple process. And at the end of it, they will give you the EIN. It will be computer generated. So there's a tip. Now, mybiz.colorado.gov is a website that you can go to with all the answers about licensing, registration, whether you have to register for sales tax here, and so on and so forth. And that's a good site to go to for knowledge about doing business in Colorado. And also I've got a plug for SCORE. SCORE, of which I am a member. We are a group of most retired. I'm only just retired, but I've been a member for 7 years. And we're a volunteer arm of the Small Business Administration. And we conduct a number of seminars and workshops like this. Some we do through the Alliance Center here. Others we do, our offices are downtown in the government building on 19th and California, I think. And they conduct there. And we do everything from social media to tax, to bookkeeping, to how to interpret a financial statement. What do you need for a startup business? how to go about getting loans for your business. I just remembered what I wanted to say about C Corps. Sorry, it was a bit long in coming. The C Corp is very good if you want to expand your business, because you can always issue more shares if somebody is interested. Either you might have an angel. I know you heard angels, but they're investors that come along with 5 or 10. If you get enough angels, you know, you might be able to raise some capital. But if you want to attract capital into your business because you've got a good chance of expanding, then the corporation is the best, because it's easier to bring on board shareholders. You just got to issue more shares. That's all. To bring somebody on board in an LLC or a partnership is a real problem, because the partnership or the LLC is already 100% full. So if you're going to take something out of the 100%, somebody's got to give something up. So if you sell, you know, if you've got 2 people in a partnership and you want to introduce a third, then and say you're going to be thirds, then the 2 members are basically selling 17% of their holdings, and there could be tax ramifications of that. There are a couple of ways of getting around it. You can make an election and state that they're buying in at this point, but they want to be treated as long-term capital gain, and there's no immediate tax ramification of that. But corporations are good for expanding businesses and sometimes raising debt, you know, raising loans and stuff like that, mezzanine debt or something like that. Anyway, I'm sorry everybody's sick of me talking, so I will shut up. I'll thank you very much for your attention. I hope you learned something. And as I said, my email, and I don't think it's up there. My email, hang on, let me check. I'm not sure whether it's Warren or just W. Yeah, my email is Warren, all lowercase, Jones @scorevolunteer, one word, .org. Oh. So if anybody wants a copy of this presentation, I'm happy to send it to you. Free of charge. Everything's free of charge. And I also I think probably got a plug in for the Alliance Centre here. They are great in helping people in this. What, are you all over or just in this area? They are great for helping people. They got very friendly and helpful staff, and they put on a lot of these seminars / workshops free of charge, and that's always a good thing. So anyway, thank you for all your attention, and I bid you a good rest of the night. You can go and have that glass of wine now.
Thank you so much.
Well, thank you. You're welcome. I'm glad you were part of it. James, good luck with your business, mate. Oh, James is gone. Oh, dear. Everything is on wheels around here. You see what I mean?
Thank you.